Welcome to the Real Estate Espresso Podcast, your morning shot of what's new in the world of real estate investing. I'm your host, Victor Menasce. On today's show, we're talking about energy. Natural gas prices have increased in many parts of the world. Natural gas is perhaps the cleanest of all fossil fuels. It's replaced coal in many of the world's power generating plants. The problem is that gas is difficult to handle. It doesn't store particularly well, and it's difficult to transport. If you can compress it by about 600 to 1 and supercool the gas, it'll transition from gas to liquid. That makes it easier to transport, but still requires highly specialized equipment to handle it. Lower pressure pipelines have been known to rupture, causing leaks, including the most recent one in the Gulf of Mexico, where Mexican company Pemex had a problem next to a production platform. The problem of transporting natural gas from the wellhead to the point of consumption creates massive global price fluctuations. The closer you are to the wellhead, the lower the price. You've got much more gas available than you can possibly consume at the point of production. Places in the world where natural gas is nearly non-existent have to import. Spain is a good example. It gets some of its gas via pipeline from Algeria, and much of Spain's power generating capacity is coming from natural gas, increasingly shipped from the United States. Only 2 months ago, spot prices in the U.S. were $2.80 per MMBTU. And in the past 60 days, prices have risen 32% in the U.S. to $3.60 per MMBTU. By comparison, prices in Spain for that exact same commodity are over $10. The European average price for gas is $8.90, and some parts of the world are paying up to $16 per MMBTU. The cost of transporting natural gas across the Atlantic or the Pacific is less than $2 per MMBTU, so clearly there's a significant price advantage to bring LNG from the U.S. to markets around the world. It's highly profitable business and easily justifies the billions in investment required to bring these mega projects to market. Over the past 5 years, there have been tens of billions in new construction projects aimed at increasing the export capacity of the United States. But like many things in the energy world, there seems to be a cycle of investment and price volatility. Shell had made several major investments around the world in expanding natural gas infrastructure. This includes a major project in Australia. When the pandemic hit and prices remained low, Shell took a major write-down in their investment in LNG. They exited their project in Australia, and they exited one project in the United States. But there's an inescapable truth. Every unit of economic output requires an equivalent unit in energy consumption. These two are highly linked. If you drew a graph of these two curves, held them up against the light, they would track almost perfectly. As a result, a major new liquefied natural gas project is finally getting underway after several years of planning and approvals. The Driftwood facility just signed their ground lease and is starting site development. And when this project is complete, it will produce 27 million metric tons of export capacity from the United States. This will virtually double the export capacity of the country. The huge spread between the spot price in Lake Charles, Louisiana, and Spain is what drives the business case for these multi-billion-dollar plants. But of course, it's not just about Spain. We're talking about France, India, Korea, China, Thailand, Vietnam, just to name a few. This one plant is going to bring about 6,500 construction jobs to the local economy for the next several years, and eventually about 600 direct permanent jobs and several thousand spin-off jobs. This, all in a community that's been ravaged by 2 hurricanes and has an acute shortage of housing. There are still people commuting from hours away to work in Lake Charles. They're coming from Lafayette, Houston, Baton Rouge. The need for quality housing is incredibly high. And many of the units that are showing up as vacancy are in fact hurricane-damaged units that have not yet been repaired. And if you've been following me for a while, you'll know that we've been invested in Lake Charles for some time, and for many of the reasons that I've just described. This market exists because it's a gateway for natural gas to the world. And when we invest in a specific deal, it's not because it's a good deal. We take the time to understand the underlying market fundamentals, the fundamentals that are needed to support long-term growth of employment in the market. This city of about 200,000 is just one of those places. But in the real world, local market forces can be difficult to predict in the short term. We saw a pullback in new construction in 2019 and 2020. That meant that some of our investments in the market saw a temporary drop in occupancy. Things went sideways. Some was due to the slowdown in LNG investment, some was due to the pandemic. But from where we sit right now, we're seeing an acceleration of investment that's making good on a long-term promise for the market. We're focused on several other growing markets, including Boise, Idaho, Spokane, Washington, Ottawa, Canada, just to name a few. When you make an investment in a market, pay close attention, not just the short-term but the long-term trends driving both supply and demand in the market. As you think about that, have an awesome rest of your day. Go make some great things happen. We'll talk to you again tomorrow.